This show is sponsored by Amplify ETFs, delivering expanded investment opportunities for investors seeking growth, income, and managed risk strategies. To learn more, visit amplifyetfs.com.
This is the Amplify quarterly update on the Capital Wealth Planning Enhanced Income ETF, symbol DIVO. My name is Jay Coulter, and joining me for this update is Kevin Simpson, the Chief Investment Officer and founder of Capital Wealth Planning that serves as the sub-advisor to the ETF. Kevin, thanks for coming on.
Thanks for having me, Jay.
All right, let's jump right in. What are your thoughts on the first quarter performance of DIVO?
Well, I couldn't be more proud of the first quarter performance and truthfully, pleasantly surprised. When we were heading into 2021, looking at forward earnings, the S&P 500 forecast from our firm, as well as many analysts, presented a potential 10-11% return in 2021, which who wouldn't be happy with that type of performance? But so much of the first quarter was beyond our expectations. And I feel like there's a lot of validity to how well investors are looking to the future, to the reopening, to the strength of the consumer, to extended low interest rates. So Q1 was a fantastic quarter and one that exceeded my personal expectations.
Excellent. So for folks that are just coming into contact with DIVO and it's new to them, walk us through the construction process of the index and the ETF.
Yeah, I think when we look at this portfolio in particular, it's a core equity income strategy. So for investors and financial advisors that are looking for income within the equity space, I think we have something very special and very unique. When we build the portfolio internally, Josh Smith, the team, all of us are looking for great companies. We identify great companies as those companies that have really good dividends, not the highest dividends, really good dividends, but more importantly, a history of having increasing those dividends over time. So it's an increasing dividend portfolio, a dividend growth portfolio. They don't necessarily need to be pure aristocrats. We're not requiring that they have a minimum threshold for yield. We're not requiring that they have to increase their dividends each and every year. If they cut the dividend, then they're not a candidate for us. But what we're trying to do is we're trying to build a best of breed portfolio, 25 to 30 companies, inclusive of all sectors. We're looking for 2.5% to 3% a year from a cumulative dividend. So you've got a very high quality, high conviction portfolio. 2.5% to 3% dividends are great cash flow right now, considering where interest rates are and probably will be for the foreseeable future. And there's no market timing. There's no sector overweighting. We never have more than 25% in any sector. No matter what our conviction may be on an individual company, we never own more than 5% in any one stock. So a really well-diversified, high quality company perspective with emphasis certainly on dividends, but also very unique to us, Jay. We look at covered calls as a secondary component. For us, we use it as a risk mitigation technique. We use it to mute volatility. But the fact is that there's an additional cash flow as a byproduct of that through our tactical covered call writing, and we can probably get into that in a second. But we're looking to generate another 2.5% to 4% a year in call premiums, so that between the dividends and the option premiums, we're building a blue chip portfolio with a 5% to 7% cumulative cash flow component. And DIVO, I think since inception, has been distributing in excess of 5%. And what's really neat about the ETF is that it distributes that on a monthly basis.
So let's talk about the tactical overlay and how you go about the process of identifying the securities that need covered calls and how you move in and out of them.
Yeah, so everything we do, Jay, is rules-based, from how we select stocks to how we sell stocks, and certainly to how we write covered calls. And for us, it's a process of looking 1 month into the future. So our sweet spot are short-term covered calls, 2, 3, 4 weeks. Out of the money, 2, 3, 4%. So if we look 30 days into the future and we go 5% higher, which allows for some upside capture on an investment, depending upon what that premium looks like, will determine whether or not we write a covered call. If we look at a listed option, 5% out of the money, 30 days into the future, if volatility is so muted that that premium will annualize out at over 2.5% to 3% a year, then we simply don't write a call. We're trying not to fight the idea that everything's going to get called away in a systematic covered call program in a rising market by being a little bit more frugal almost in how we write covered calls. We're going to tend to write lots of covered calls in high volatile markets and far fewer covered calls in low volatile markets. So I think that rules-based process allows for, at least from a total return perspective, allows for the investors, for the financial advisors to think about it kind of the way I think about it, which is if markets are rising, we want to participate in that rising market from a total return. And maybe we're not going to exceed it because we're having covered calls as a component in the portfolio. But if we can capture 80 to 90% of that upside, well, that's a win. And we certainly did that in the first quarter. More importantly to us, if markets are declining, we want to limit that downside capture, that downside exposure. If we can put participants in only 65 to 75% of that down market, then that's really important to us. And we certainly were able to do that in 2020, at least the bad part, when the stock market went down. And then regardless of what markets are doing, up, down, or sideways, if we can drive that cash flow component to between that 5 to 7% target, then we feel like we really have that core equity income strategy that allows clients and advisors to take an income stream with confidence and also to expect an increasing cash flow over time as a result of that dividend growth component that's so important in every stock that we own.
It's such a great story and such an easy process for the financial advisor to understand and the clients to understand and benefit from. As you look back on the first quarter, could you speak to a couple of trades that were executed inside the strategy?
Yeah, sometimes with covered calls, you're going to cycle out of names and begrudgingly, you see some of your favorite names go over time, but amazing profits are never a bad thing. And someone smarter than me said, anytime you take a profit, it's not the worst thing in the world. So we did cycle out of Caterpillar. We also moved out of Home Depot, and some, not all, but we're still big, huge fans, and we're rebuilding the position. But Apple were called away. So you have situations where these stocks have made tremendous runs. It's given us an opportunity to take some profits along the way. We've added Medtronic, we've added Honeywell. As I mentioned, we're adding Apple back into the portfolio. And you can bet if you see Caterpillar or Home Depot sell off, they're names that we love long-term, and we're never afraid to go back into them. But as far as the covered call component, it's an example of a sell discipline that forces us at times to sell things that are high. That doesn't mean they can't go higher. And in the case of Apple, like I said, we're rebuilding the position as we speak. But the cycling of this portfolio is that sometimes the name changes, but the concept of high quality, high earnings, high free cash flow, high dividends, they're going to be a similar component across all the names that we own.
So Kevin, DIVO had a very successful first quarter. It's still a 5-star rated fund. As you look forward to the rest of the year, what do you see unfolding?
Well, we continue to be really optimistic on the American consumer. The trade of, I'll just speak for me personally, the thought process of going to a movie theater, going to a crowded restaurant, getting on a subway, going to a baseball game. All of these things are going to fuel the economy. If the American consumer puts this economy on its shoulders and spends like I think it will, it's going to be tremendous what we see in terms of the stock market. I always like to say that it's Main Street that makes Wall Street. And I think that Main Street has more pent up demand than we've seen as a society in my lifetime, maybe going back to World War II. That doesn't mean that there's green grass forever. Certainly there isn't. But with a low interest rate environment and a strong spending consumer, we can have a fantastic second, third, fourth quarter for 2021. And that can carry into 2022. So we've gone from a global pandemic and a horrific 2020 to what I think is going to be a much brighter future in 2021.
Excellent. Well, thank you for coming on and talking about the first quarter. We look forward to catching up with you after we get through the second quarter. For more information on the ETF DIVO, please visit amplifyetfs.com. That's amplifyetfs.com.
Thanks for having me, Jay. I'll see you next quarter.